back, brother. This content is for those genuinely interested in men's rights. It covers complex, controversial topics that may not suit a general audience. If you're not part of the men's rights community, this video isn't for you, so feel free to tune out now. I'm Conrad Riker, a writer and advocate for fairness, dignity, and respect for men. This movement isn't about division, but addressing systemic injustices in divorce, family law, and societal expectations. Inspired by hard-working men unfairly stripped of their rights, I write for balance and justice. Together, we can change the narrative. Please like and subscribe if you appreciate this video, as it will help get the word out to those who need it. Thank you. Please relax and enjoy. This is an excerpt from Digital Wealth, a rational man's blueprint for crypto success. Digital Wealth, a rational man's blueprint for crypto success, is an ebook available in all good stores. If you're holding this book, you're either a man who's tired of losing money in the crypto casino or someone who's curious about how to turn digital chaos into real wealth. Let me be clear, this book is not for everyone. If you're looking for a feel-good guide to investing in meme coins or chasing the latest TikTok-fueled pump and dump scheme, put this down now. Go knit a sweater, binge a Netflix series, or do whatever makes you feel warm and fuzzy. This book is for rational men who value logic, discipline, and long-term success over short-term thrills and empty promises. I didn't write this book because I think crypto is a magical money tree. I wrote it because I've seen too many men, myself included, get burned by the same traps: greed, hype, and emotional decision-making. I've lost money, time, and sleep chasing the next big thing, only to realize that the crypto market is a battlefield where the unprepared get slaughtered. But I've also learned how to navigate it, how to separate the signal from the noise, and how to build wealth in a space that's equal parts opportunity and minefield. This book is the result of years of trial and error, research, and hard-earned lessons. It's not a get-rich-quick manual. It's a blueprint for thinking clearly, acting decisively, and avoiding the mistakes that destroy most investors. You'll learn how to spot scams, understand the psychology of trading, and develop a strategy that aligns with the 4-year market cycle. You'll also gain insights into the philosophical underpinnings of Bitcoin, the Darwinian nature of altcoins, and the regulatory challenges that could make or break your portfolio. But this book isn't just about making money. It's about reclaiming control over your financial future in a world that's increasingly hostile to individual sovereignty. It's about understanding the forces shaping the future of money and positioning yourself to thrive in the digital age. And it's about doing all of this as a rational man who values truth over hype, discipline over impulse, and long-term success over fleeting gains. If you're ready to stop gambling and start building real wealth, this book is for you. If you're not, that's fine. Just don't waste your time pretending. The crypto market doesn't care about your feelings, and neither do I. What it does care about is your ability to think clearly, act decisively, and stay one step ahead of the herd. Let's get to work. With the introduction completed, we are jumping to an extract from the book. In 2012, when Bitcoin underwent its first halving, the price was hovering around $12. Few could have predicted that this event would set the stage for one of the most explosive bull runs in financial history. By 2013, Bitcoin had surged to over $1,000, a staggering increase of more than 8,000%. This wasn't just luck. It was the result of a fundamental economic principle: scarcity. When the supply of new Bitcoins was cut in half, the market responded with a frenzy of buying activity. The halving event acted as a catalyst, igniting a firestorm of speculation and investment. This pattern has repeated itself with remarkable consistency in subsequent cycles, proving that timing the market isn't just about luck. It's about understanding the underlying mechanics of supply and demand. In 2016, the second Bitcoin halving took place. At that time, Bitcoin was priced at around $650. Over the next year and a half, its value surged to nearly $20,000. This wasn't a random increase. It was the result of a deliberate interplay between limited supply and market behavior. The halving cut the do-it-yourself creation of new Bitcoins from 3,600 to 18,000, causing a supply shortage that pushed prices higher. Media coverage amplified this effect, with reports declaring the end of traditional money and the emergence of digital gold. This hype created a cycle, attracting even more investors. The outcome was a massive price surge that turned early investors into millionaires and solidified Bitcoin's role in mainstream finance. By 2020, the third halving event had arrived, and the market was primed for another explosive rally. This time, however, the landscape had changed. Institutional investors had entered the fray, bringing with them a level of legitimacy and stability that was previously absent. Companies like MicroStrategy and Tesla made headlines by adding Bitcoin to their balance sheets, signaling to the world that this was no longer a fringe asset. The halving event reduced the do-it-yourself supply of new Bitcoins from 1,800 to 900, further tightening the supply. The result was a bull run that saw Bitcoin reach an all-time high of $69,000 in 2021. This wasn't just a speculative bubble. It was a validation of Bitcoin's role as a store of value in an increasingly uncertain world. But what about the altcoins? The 2017 altcoin season was a wild ride, with many coins experiencing gains of over 1,000% in a matter of months. Ethereum, for example, went from $8 to over $1,400 in less than a year. This wasn't just a fluke. It was the result of a perfect storm of factors, including the rise of initial coin offerings, ICOs, and the growing popularity of smart contracts. However, the aftermath was brutal, with many coins losing over 90% of their value in the subsequent bear market. This serves as a cautionary tale for those who think they can time the market perfectly. While the potential rewards are enormous, so are the risks. The 2021 altcoin season was no less dramatic, with the rise of decentralized finance, DeFi, taking center stage. Coins like Chainlink and Aave saw gains of over 1,000% as investors flocked to platforms offering high yields and innovative financial products. However, this bull run was also marked by a level of sophistication that was absent in previous cycles. Institutional investors were now actively participating in the DeFi space, bringing with them a level of scrutiny and due diligence that was previously lacking. This has led to a more mature market, one that is less prone to the wild swings of the past. But make no mistake, the potential for massive gains still exists, as does the risk of catastrophic losses. One of the most compelling arguments for the 4-year cycle is the concept of diminishing returns. While each halving event has historically led to a bull run, the magnitude of these runs has decreased over time. The first halving saw an increase of over 8,000%, the second around 3,000%, and the third just over 500%. This trend suggests that while the 4-year cycle is still a powerful force, its impact may be waning. However, this doesn't mean that the cycle is dead. It simply means that investors need to adjust their expectations. The days of 10,000% gains may be behind us, but the potential for significant returns still exists for those who are willing to do their homework and take calculated risks. Global economic conditions significantly impact Bitcoin's performance. During periods of economic instability, like the 28th financial crisis or the 2020 pandemic, Bitcoin has frequently been viewed as a safe haven asset. This was especially clear in 2021, when massive monetary stimulus sparked concerns about inflation and currency devaluation. In this context, Bitcoin's limited supply and decentralized structure made it a compelling option compared to traditional assets. This pattern is expected to persist as central banks worldwide continue to print money at high rates. For logical investors, this offers a distinct chance to guard against inflation and preserve wealth. Understanding the psychological effects of halving events is important. These events generate urgency and FOMO, fear of missing out, among investors, pushing prices up in the short term. However, this excitement is often followed by a period of adjustment and correction as the market adjusts to the new supply conditions. This pattern of rapid growth and decline is common in markets, but is especially noticeable in crypto. For those who can manage their emotions and follow a consistent investment plan, the 4-year cycle provides a chance to take advantage of these trends. The 4-year cycle is a useful tool for timing the market, but it does not guarantee success. Historical data shows that halving events have often led to bull runs, but the size of these runs has shrunk over time. The growing presence of institutional investors and the market's increasing complexity have introduced new challenges. For thoughtful investors, the focus should be on staying informed, maintaining discipline, and being ready for market fluctuations. By grasping how the 4-year cycle works and its effect on market behavior, you can better position yourself to seize opportunities and reduce risks. Thank you for listening. Thank you for your interest in digital wealth, a rational man's blueprint for crypto success, available in all good bookstores. Please like and subscribe. Thank you and God bless.